Good day and welcome to our presentation for the 7th of October 2020. I'd like to begin as usual with a discussion of the S&P 500. On your screen there you should be able to see the S&P 500 over the last 6 months, and you can see that we've come right out of the V bottom that was caused by COVID, and now we've made a new record high there at 3580. That was on the 2nd of September. But most of the month of September has been taken up with this correction, which you see over here, which has actually taken the S&P down 9.3%. That correction seems to have finished, and we're now in a sort of nascent recovery, which is going on over here, as you see there. The reasons for the correction, well, there's been a resurgence of COVID-19 in the UK and France and Spain, and to a lesser extent in the United States, where they've had a slight uptick in cases. Of course, we've had the news that Donald Trump got COVID-19. We could call that poetic justice, I guess. But we do not believe that Trump's diagnosis is a major factor in the market. And we think this correction was always going to be fairly short-lived. Any resurgence of the virus in Europe should be better coped with because it's amongst first world countries like UK and France. And the virus is much better understood. The treatment for the virus is much better. Here in South Africa, our death rate from the virus has dropped sharply as treatments have improved. The other major factor, of course, in the correction was the US jobs report for September 2020. America added 661,000 jobs, which was less than the 850,000 which were generally expected by analysts, and so it had a negative impact on the S&P 500. But nonetheless, that 661,000 new jobs, 200,000 of those were in bars and restaurants, 142,000 were in retailers. The unemployment rate in America has come down to 7.9%, which is a big improvement on the 14.7% which it was in April, and better than the forecasts of economists, which were around 8.2%. Still got a long way to go before it reaches the 3.5% that it was before COVID-19. The United States Congress is arguing about a Phase 4 stimulation package for the economy. And then suddenly last night, Donald Trump tweeted that he was withdrawing from those discussions and that there would be no further stimulation package. As a result, as you can see here from the candle on your screen, the S&P 500 fell by 1.5% in the last hour of trade. It was actually doing quite well. You can see from the upside shadow here, it was up about 0.5%, nearly 0.5%, and then he made this bombshell announcement and the market fell by about 1.5%, so it ended up down on the day. This is a typical Donald Trump move. He's trying to show everyone that he is still in charge and that he has lots of power and that he's the main mover and shaker in America. However, the markets have become used to his behavior and they tend to discount it very quickly. So we don't think that this will signal a new downward trend. In fact, we believe that tonight on Wall Street, a substantial recovery of that drop will take place. So that's going to be short-lived. That's really what we're saying. It's a publicity stunt and nothing more than that. Obviously, he's aware that he's trailing Biden in the elections. The elections are an issue, and on paper, at least, Joe Biden looks like he's well ahead. But Trump surprised analysts in 2016, and he may surprise us again. However, we don't think that the election is a major factor for markets. If Trump wins, it will be business as usual, and nothing really will change. And if Biden wins, he will only begin to impact the markets next year, at the earliest. Ergo, this election is not really a big factor. What is a big factor is the recovery in the Chinese economy. Exports now from China have been up for 3 months in a row, and in August month, They were 10% above the 2019 August month. So that shows that the Chinese economy is not only growing and recovering, but it's actually doing better than it did in 2019. Altogether, the Chinese have a trade surplus of $59 billion. $32 billion of that comes from the United States alone. These figures are far above analysts' expectations, and they indicate to me that the 12-year bull market, which has been going on in the S&P 500, will continue. The world economy will recover, is recovering. Okay, let us turn our attention to South Africa and what is going on locally. Just a few political points to begin with. The corruption in the TERS scheme through UIF shows that corruption is systemic. It affects almost every department and state-owned enterprise in South Africa. The government's ability to run the country is emasculated by this corruption and also incompetence to some degree and indolence. Cyril Ramaphosa won a battle within the ANC over the last month. The NEC has ruled that members who are accused or charged cannot stay in office until their names are cleared. I'm not sure to what extent this will actually impact on what happens. And of course, we had the news last night that Ace Magashula, who's the ANC General Secretary and who's on the NEC, has been charged or is going to be charged with dereliction of duty. So we look forward to seeing whether or not he will abandon his post in the NEC, whether he will be suspended. That will be obviously the test of this new policy. Nonetheless, this decision by the NEC that ANC members cannot stay in office until their names are cleared is undoubtedly a milestone in the fight that Ramaphosa has been conducting against the Zuma/Gupta faction. It will impact on Magashula and many other senior ANC members. This recent trip to Zimbabwe also revealed the importance of separating the ANC from the government itself. And it becomes apparent to us that COVID-19 has strengthened Ramaphosa's position within the ANC. It seems like he was able to squeeze an apology out of Magashula, which is also a salutary event. Turning to the economy, of course, we had the figures out for the second quarter. Nobody expected the second quarter to be great. It contracted by 16.4%, the economy, that's GDP, in the second quarter. Of course, it's very irritating that the financial media continues to say it was a 51% contraction. The way they got to that number was by annualizing the 16.4% contraction in the second quarter and then adjusting it for seasonal factors. But nobody expects the bloodbath of the second quarter to be repeated in the third quarter. In fact, the third quarter should be quite positive, as will the fourth quarter. So to keep on referring to it as a 51% contraction is just bad press. Well, it's press sensationalism, really. The contraction, however, was worse than expected. The Reserve Bank is now projecting an 8.2% contraction over the whole of 2020. And obviously, President Ramaphosa must use this dire situation to push for economic reforms. We've been moved down to level 1, and that obviously helps the economy. The OECD says that South African GDP will contract by 11.5% in 2020. That is by far the worst prediction that I've seen, and it is based on the fact that they're expecting more load shedding from Eskom. And the load shedding has been going on, but it is not nearly as bad as it has been in the past. The OECD also, by the way, says that the world's GDP will fall by 4.5% in 2020 and then gain 5% in 2021. Looking at other factors in the economy, tax collections to August for the year so far to August were down by 103 billion rand. That's about 20% down on last year. The full year is expected to be over 300 billion down. And that is excluding the 70 billion rand of tax relief for COVID-19. So the figures are looking pretty dismal. The Reserve Bank is looking for various ways to stimulate the economy. They basically have three approaches open to them. Open market operations, whereby they buy bonds on the open market. So far they've bought 39 billion rands worth of bonds, but their buying has dropped off very sharply, and in August they only bought 350 million rands worth of bonds. The market appears to be normalizing. They also have dropped interest rates by 3%, as we know, and that helps a lot. And they've reduced the commercial bank's reserve ratio, which enables the commercial banks to lend more out. Of course, the governor, Kanyago, is very much against quantitative easing, but we believe that quantitative easing is probably inevitable given the situation and the government's overall debt levels. The unemployment statistics came out. They are unreliable because a lot of the questions were done by phone this time. They normally get an 87% contact rate when they're doing face-to-face questions. But this, done over the phone, they only got a 57% contact rate, so the figures are probably skewed somewhat. However, they pointed to 2.2 million jobs lost in the period. The number of employed people fell from about 16.3 million in South Africa to 14.1 million. That is better than the 3 million which most analysts and economists were predicting. And we also think that a lot of those people have probably been re-employed. On top of the lost jobs, about 80% of people who have kept their jobs have had to take a cut in salary by an average of roughly 20%. These two factors, the lost jobs and the salary cuts, will impact on consumer spending. And while we're talking about consumer spending, credit extension was 5.1% in July, which is down from June's 5.6%. Evidently, consumers and businesses are consolidating. They're not borrowing more money. There's a great deal of uncertainty and a lack of confidence out there. People are hoarding cash and paying off debt wherever possible. The ABSA Purchasing Managers Index for August was 57.3. That's much better than economists were predicting. Economists were predicting 50.7 for that index. But it is in fact the highest level for 13 years, which shows that economists have been far too pessimistic about this COVID-19 and the impact it's going to have on the economy. Many were predicting a 10% contraction in GDP in 2020, and the actual figure is likely to be much better. There's a lot of pent-up demand in the economy and spare capacity to expand quickly, and production is coming back rapidly. What was interesting is that the new sales component of the PMI was up 71.1%. So there are plenty of orders for manufacturers who are getting back to business. Small, medium, and micro enterprises, SMMEs as they are known, account for about 38% of gross domestic product, and they employ thousands and thousands of people. Oecd is a business which provides point-of-sale equipment to SMMEs, and they say that sales through these items of equipment, which are things like till points and so forth, reached 95% of pre-COVID sales last month, so that's good. South Africa is clearly getting back to business. Mining and manufacturing are showing clear signs of recovery in July. Mining production was up 20%, manufacturing was up 7.6%. July retail sales were 9.7% lower than in 2019, but that's a considerable improvement. BankServe's take-home pay index saw a drop of 20% in the amount of money that consumers are receiving directly into their banks. So their take-home pay was down by 20%. Of course, the third quarter will be much better than the second. Motor vehicle sales were also down by 34.6% in August when compared to August 2019. But again, that's to be expected. That sector is asking for the government to keep interest rates at their low levels that they are at now. Vehicle exports were also down 40%, which is another major factor. Commercial banks have provided at least 20 billion rand for bad debts, and we don't obviously know how much bad debt they're going to have, but there are indications that there is going to be a considerable amount of bad debt. Trade accounts, overdrafts, personal loan accounts, all those things are going to be behind. There are about, credit active consumers are behind of about 3 months on their repayments. And the fact that those that are behind 3 months or more have jumped from 4% to 8%, which shows that there are going to be bad debts. All right, let's turn our attention to the rand. I think that's very important. It is a place where all these things are discounted. So here's the rand, and I've drawn this graph to show the alternation between risk on and risk off. Obviously, the latest bout of corruption in the ANC over the personal protective equipment has damaged the rand quite badly. Edward Kieswetter, who's the commissioner at South African Revenue Service, says that 63% of the companies that won tenders for PPE had no tax clearance, and that is a requirement. It's a requirement that any company that wins a government tender must have a tax clearance certificate, and 63% of them didn't. 22 of those companies had direct associations with politically connected people, and of the 2 billion rand that was set aside for PPE, 65% or 1.3 billion was given in tenders to politically connected companies. The culture of corruption in South Africa runs deep. It's going to be very difficult for the President or Parliament to give effect to their decisions when there is so much corruption around. Luckily, the hawks have made arrests recently and restored some international faith in our currency and in our country. And that is particularly true, of course, with the impending arrest of Ace Magashula. Externally, the second wave of COVID-19 in the UK, France and Spain caused a sharp shift to risk off. So the rand is being buffeted, as you can see on the chart here, by alternating bouts of risk off and risk on. You can see the underlying strengthening trend, and then there's a bout of risk off here. And then we moved back into a risk-on phase for quite a while until the middle of September. Then there was a sharp risk-off, and then again back to the risk-on again. And then last night, as you can see here, Donald Trump's little escapade caused the rand to weaken quite sharply. It actually fell by about 3.5%. On the 21st of September, we had a sudden shift to risk-off, and the S&P fell quite sharply. The rand fell 3.5%. So the rand is at the whip end of this risk-on, risk-off alternating sentiment internationally. When we move to risk-off, international investors get scared. They take their money out of emerging markets like South Africa and put it into U.S. Treasury bills. The opposite happens when they are risk-on. They take their money out of U.S. Treasury bills, which are paying about 0.7% per annum, below the American inflation rate of 1.4%. And then they bring it back to high-yield countries like South Africa, where they can get 9 or 9.5% on a government bond against an inflation rate which is around 3%. We believe that the rand is fundamentally undervalued, even now, and we're expecting it to go below 16 rand to the dollar in due course, probably relatively soon. So the rand, we think, is undervalued. All right, so let's look at some other things. State-owned enterprises within the government. The SAA debacle is continuing. The government is desperately trying to find 10.4 billion rand. The business rescue practitioners say that they have managed to raise some of that money, but more is required, and the government is scratching around to find where they can take money from one or other of the votes in the government, one or the other of the departments, to put into SAA. Because they're not allowed to increase the debt levels. That's the key thing. That will be badly viewed overseas if we increase debt levels to support a new business in the airline industry using the same staff and assets as SAA used. Airlines all over the world are going bust, or at least losing money. And there seems to be no business plan for this new SAA. This will surely mean further injections of cash from taxpayers to support this new company in the future. And why do we need a national airline anyway? What is the point of this thing? In our view, it's pure ego. And also we believe that SAA represents a low point for the Ramaphosa administration so far. Eskom, of course, the debt level has risen to 488 billion now, up from 440 billion at the end of 2019. The cost of interest loan is now 70 billion rand per annum, just the interest on that debt. And by 2021, that will rise to 100 billion. The government has just put in 49 billion to close the gap, but clearly the situation is not sustainable. The recent social compact with NEDLAC does not deal with the debt situation. Sooner or later, we believe, quantitative easing will be needed and will be invoked, despite Kanyago. The seizure of the Machabeng municipality's bank account, following on from the seizure of the Maluti municipality's bank account in July, comes as good news. It shows that De Ruyter, who's the new CEO at Eskom, is doing his work and he's kicking backsides and taking names. That also comes with the news that the managers of Tutuka and Kendal power stations have been suspended. So obviously he is holding people to account. Now the Eskom board, of course, is after him. This is traditional. They go after the guy who's doing the reform. They don't like him rocking the boat, but we will see what happens. The post office has got to also be one of the worst organizations in South Africa. It registered a 925 million rand loss in the first quarter of this year, and they're asking the government for 7 billion rand in support. This is a business that's been losing money for 13 years, and it's a signally useless organization. Mark Barnes was the only hope there. He's now resigned as CEO. And the post office's income has fallen from 781 million last year to 480 million this year. They are only making about 39% of postal deliveries. Like SAA, this is an organization that South Africa just does not need and just cannot afford. It's the most unbelievably useless operation. Similar also to South African Broadcasting Corporation, which is also a waste of time and money, apparently. Right, looking at COVID-19 inside South Africa, a study in the Western Cape found that pregnant women and HIV-positive people in the Western Cape had antibodies, a large proportion of them, as many as 41% of them. This shows that there's a high degree of herd immunity, especially in informal settlements. This is probably also true in Gauteng's informal settlements. And we believe that this is what is behind the drop in the number of cases and deaths. The disease is apparently swept through all our informal settlements, and most of the people who were vulnerable, old people and people with pre-existing conditions, have died. The others are very young. Also, they benefited from the BCG vaccination, which is universal in South Africa and has been for many decades. So we believe that there's not going to be a second wave of COVID-19 here in South Africa because of those factors. Principally the BCG vaccination, which makes us less vulnerable to COVID-type viruses, and also the fact that our population is relatively young. We don't have many people living in the squatter camps who are over the age of 60. Of course, we've got a huge problem with our border control in this country. There's a massive flood of people coming into this country all the time. Illegal immigrants coming mainly from Zimbabwe, where their economy is imploding. That lack of border control is costing South Africa a fortune. There are also massive imports of illegal cigarettes, alcohol, clothing, motor vehicles, all sorts of things. Illegal immigrants are generating housing shortages in this country and rising crime levels. We really need to get into control of our borders. All right, let's take a look at some companies now that I've been through all that. In the last confidential report, which we did on the 2nd of September last month, just over a month ago, we recommended that you should take a close look at cash build. So I'd just like to put that graph on the screen. Right. Here you can see cash build. I'm just going to put a bit more data on the screen. 2 years, I reckon. Maybe even 5 years. There we are. So that shows you the long-term downward trend line in cash build. Not surprising, really, given the damage that's been done to the construction industry. But then there's an upside breakout. And you can see here I've put an arrow where our confidential report came out last month, where we recommended that you get into cash build. Since that time, since that day, the share has gone up from 189.25, where it was there, up to now 217 Rand. So it's gained 14.7% in just over a month. It's a pretty good return. I hope that some of you took advantage of that. We also published an article on the 5th of September and drew your attention to 2 other shares, Massmart. Obviously, you might say to us, well, why are you interested in Massmart? I mean, surely that's a terrible company. And it has been a bad company. Let's try and get this graph right here. Okay, there you can see, this is a 1-year chart now. And you can see the downward trend line. Massmart brought in this chap from overseas, from Walmart, a guy called Mitchell Slape. And he's been really revamping that operation, and I think he knows it pretty well by now. What is interesting to me is that he decided to buy 8 million rands worth of Massmart shares the other day. He got them for a good price, just under 28 Rand each. And you can see there's a clear upside breakout in the share here. And the share closed last night at 32 Rand, around 32 Rand. So we think that's a good buy. It will recover quickly. And it's trading at what we believe is quite a discount. The other share that we recommended in that same article was Bluetel. And this is a company run by 2 Jewish brothers, clever guys. They have taken a hell of a hammering because of their investment in Cell C. So they clearly made a mistake with Cell C, in our opinion. Maybe not from a long-term strategic point of view, but certainly in the short term. So they bought 45% of Cell C. They paid a lot of money for it, and they've had to write that investment down to 0. But now that they've written it down to 0, they can't take any more losses from Cell C. And they may make some substantial gains. I mean, we don't believe that Cell C is worth nothing. But in any event, they are getting into a new business, which is the business of collecting electricity debts for municipalities. There are 257 municipalities, and together they are collectively owed 191 billion Rand by electricity users. Some of that debt must be collectible. Most of that debt is held by people who have property. That's why they want the electricity. So where you've got a person who owns property, collecting the debt is a fairly straightforward process. So we think this is a good business for them to go into. They are intending to install pay-as-you-go meters everywhere, and altogether it looks like quite a good business opportunity. If we look at it technically, you can see how the share has fallen because of its Cell C exposure, but now it's done what we call a reverse head and shoulders formation here at the bottom. So there's the left shoulder you can see there, the head, the right shoulder, and now an upside breakout over here. So that's why we suggested that you get into this share. So that's Bluetel. They're looking quite good. Let us talk now about Sibanya. Sibanya, of course, as you know, is a precious metals mining company that has popped up in the last 5 years. They've done extremely well. Just put a bit more data on the screen, let's say 2 years. You can see here that since their low point in 2018, about November 2018, this share has gone up dramatically. In fact, over the last 2 years, it's gone up by about 650%. So it's been very, very dramatic. But it is, of course, a precious metals share, which means that it is volatile and vulnerable to the prices of international commodities. It's a major producer of platinum group metals, particularly platinum itself, palladium and rhodium. These 3 metals are used in auto catalysts. Platinum is used in diesel engines and palladium in petrol engines. Europe is the biggest buyer of those metals. 50% of the world's platinum goes to Europe and about 25% of its palladium. Rhodium is used in both diesel and petrol engines. COVID-19 has caused the demand for vehicles to drop quite sharply. And there's now obviously the second wave of infections taking place in parts of Europe. Platinum and palladium are off their highs, but Sibanya has done very well. And the question really is now, is it time to take profits? And we probably think it is. As you can see, technically here's a double top that we are seeing in the share. And certainly if you've bought this share any time in the last 2 years, you've done extremely well. So maybe it's time to take profits. That's what we're suggesting. Okay, the next share I want to look at is Metrofile. Metrofile is a document storage, management, and backup company. I'm just going to put a bit more data on the screen here. Here we go. Here you can see again you've got this long-term downward trend line and a recent upside breakout over here. This company is 57.4% black owned. A big shareholder there is the Mine Workers Investment Company, which owns 38.64%. It has 52 facilities around the country with 100,000 offices and warehouse, 100,000 square meters of office and warehouse space. In their recent trading statement, they said that headline earnings per share would be up between 16% and 25% for the year to the 30th of June. It's quite unusual in the current environment to find companies that are reporting on the year to the 30th of June and talking about a rise in headline earnings per share as opposed to a fall. There's another aspect to this company, which is that an American firm called Housatonic Partners, before COVID-19 started, they made a bid to buy out Metrofile. They put that bid on hold because of COVID-19, but it's now back on the table. And we think that some kind of upside breakout here is probably impending. Okay, the next share I want to look at is Motus. You may recall that Motus is a motor car company or a motor car dealership company that was spun out of Imperial in November 2018. So I just want to put, again, a bit more data on the screen here. Here you can see that obviously they had... because they're exposed to the motor industry, and the motor industry has been doing pretty badly during COVID, you can see how the impact of COVID-19 came through on the share, but then it formed this island formation, which it's been in for the last 6 or so months, and now we've got an upside breakout over here. They import and sell more than 80,000 vehicles per annum. They have 356 dealerships and 134 rental outlets, particularly Tempest Rentals and Europcar. 20%, they have a 20% stake, share of the South African retail vehicle market, and very strong cash flows. So we think that this is a share which you should possibly be looking at. The next one I want to look at is Grand Parade. And in fact, this is the last share I'm going to talk about today. This is a BEE investment holding company, and they've just sold their stake in Burger King. So again, I just want to put the chart on the screen. There it is. You can see there's a long-term downward trend line. You can see the impact of COVID-19. And here is what looks like to us an upside breakout. One of the interesting things about this company is that they have a major stake of this company is held by a company called Venture Capital Partners. They've increased their stake from 8% to 21%, which shows that they have faith in this business. They are turnaround specialists. So this company is now concentrating on its main business of gaming. So that's one-armed bandits and things like that. They're trading at half their net asset value. So the net asset value is about 400 cents and the share is trading for around 200. We believe that this share also is due for an upward breakout. Well, ladies and gentlemen, thank you for listening to me. I hope you got something of value out of that. And I'll talk to you again next month on the first Wednesday of November. Thank you for listening.